Gold has not only moved to these record highs, but stayed there. Think of it this way, and I never heard China, they had been buying, and you get a report from the World Gold Council. Whereas last week, I think, China came out and said, we're pausing our purchases. Well, that makes sense. They're buying for 18 months, beginning at $1,200. It's not a record high. You say, I'm going to pause this, going to bring it down, then they can accumulate again. What we are witnessing is the end of fiat currencies as we know it. In other words, I think gold has become a currency more than a hedge of inflation. In the eyes of investors and individuals, it holds intrinsic value. Fiat currencies hold less and less.
On Thursday morning in Europe, gold prices reached a weekly high, aiming to recapture the pivotal resistance of the 50-day simple moving average. This surge is driven by recent U.S. macroeconomic data indicating signs of easing inflation and a slowing economy, fueling speculation that the Federal Reserve might cut interest rates twice this year. These factors have directed investment flows towards the non-yielding yellow metal. GaryWagner, editor of THEGoldForecast.com, attributes the sustained value of gold to a growing lack of confidence in fiat currencies. Gold is increasingly seen as a currency in its own right, rather than merely a hedge against inflation. Wagner explains that gold has risen approximately 12% year-to-date, and despite this impressive increase, many investors intend to continue investing in the precious metal. China's ongoing gold-buying spree highlights its strategic move to diversify its reserves. Recent data shows this trend is not limited to China. Countries such as Turkey and several Middle Eastern nations are also significantly increasing their gold reserves. Wagner notes that the substantial movement in gold prices can be largely attributed to record-level purchases by central banks, particularly in India and China. However, these purchases alone do not account for the sustained high prices. The Congressional Budget Office projects this year's budget deficit to be roughly $2 trillion, $400 billion more than forecast in February and $300 billion larger than last year's deficit. This is unprecedented given the growing economy and nearly flat defense spending. The deficit this fiscal year will be 7% of GDP, a figure that exceeds levels seen during some recessions. Wagner suggests that while reducing national debts and adhering to fiscal discipline could potentially alter this dynamic, historically, nations have struggled to maintain such measures. Consequently, the preference for gold and other stable assets will likely persist as a hedge against the ongoing devaluation of fiat currencies. Join us as we delve into Gary Wagner's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you and enjoy the video.
It's not a simple yes or no. Do I think that the majority of the move in gold was precipitated by large central banks buying, such as India and China? They were large, huge players. They bought at record levels, but that is not the reason. I believe gold has not only moved to these record highs, but stayed there. Think of it this way, and I never heard China, they had been buying, and you get a report from the World Gold Council. Whereas last week, I think, China came out and said, we're pausing our purchases, right? Well, that makes sense. They're buying for 18 months, beginning at $1,200. It's not a record high. You say, I'm going to pause this, going to bring it down, then they can accumulate again. I think what we are witnessing is the end of fiat currencies as we know it. In other words, I think gold has become a currency more than a hedge of inflation, and in the eyes of investors and individuals, it holds intrinsic value. Fiat currencies hold less and less. Yes, they are guaranteed by the value of the government that prints it, but they keep buying less product for the same note. And so gold tends not to. And I believe that gold is really accepted as the ultimate hard asset. I'm talking about the fact that people understand more and more that it's just being watered down as governments print more money and accumulate debt. At what point will that not allow governments to kick the can down the road? I have no idea. This is an experiment that started in the 40s, after 40s and 50s, after World War II. I don't think currencies are in favor as much as storage of wealth. Currencies are there to purchase goods, to transact business. That will always be there, but it might be a gold note again. I just don't think people have the same faith in currencies because, as a rule of thumb, if you look over the last 10 years, they have all been devaluing. Now when I say devaluing, I mean their buying power, not how strong they are against another currency. In a non-100% correlative way, it's been doing that for the last 100 years. And we've talked about my story about a gold coin and a $20 bill in the 1900s, when it bought. And if you move forward to today, that gold coin still buys the same thing, and that $20 bill doesn't. So that's always been occurring. Now, could that stop? Absolutely, if we actually got a way to reduce debt, to live within our means. And I've never thought that that could be done. I think Bill Clinton, they say, did that for a small time, but we're a spending nation. Globally, all of these nations spend, and they spend more than they take in. You can't have a budget that exceeds your GDP, because all you're doing is passing it on to the next generation, the next year. At some point, I would think that's going to come and bite them. However, it hasn't, and maybe it never will. We don't know how this saga is going to end. At the end of the day, you're correct. You're going to always use currency for transactions, but you'll store your wealth and then convert that to currency, whether it's land, whether it's commodities, whether it's gold, and then do the conversion. Because we're never going to go back to the day where we traded a cow for 2 goats. But at the same time, corporations as well as individuals recognize the fact that the buying power has consistently gone down for over 100 years.
GaryWagner compares the current gold market dynamics to those from a decade ago, notably the rise to $1,900 in 2011, followed by a drop to $1,200 between 2011 and 2015. It took over 6 years for gold to recover and surpass previous highs. Today, gold prices are pushing above initial resistance levels despite disappointing economic data, with the market last trading at $2,350.50 an ounce, up 0.15% on the day. The gold market has shown resilience, consolidating and largely ignoring economic indicators. This behavior suggests that the recent corrective decline may be over. If gold continues its upward trajectory, it could surpass the $2,360 to $2,362 zone, reach the $2,387 to $2,388 intermediate hurdle, and aim for the $2,400 mark. Momentum might even extend toward the all-time peak of around $2,450, last touched in May. Wagner emphasizes the importance of the $2,317 support level, which is critical as both a Fibonacci number and a double bottom. A break below $2,317 could indicate lower prices. However, if gold remains above this level, it could aim for $2,400 in the short term. Let's get back to the interview.
What I'm looking at is this. We're looking at gold moving from $2,045 middle of February up to the first of 2 record highs. This one's actually, this one back adjust, so the prices actually aren't correct. But what you saw was a low that came in on April the 30th, and the recent low that came in on Monday, June 10th were roughly the same. That is also a 61.8% retracement of this move up. So in other words, from the move from 2045 up to the highs and then the correction, it's actually reversed. It's a 38.2, is an acceptable correction. And I think that there is too much interest in the precious metals. We've seen gold go up like this in the past, but it was followed by a huge decline. Think of middle of 2011, runs to 1900. And then between 2011, 12, 13, and 14, and 15, it traded between 1800 and 1500 for 3 years and then dropped to 1020. So it literally halved in terms of its pricing, from 2000 to 1000. Then it took over 6 years to start moving back up. Now it has exceeded that. If you compare that to buying power of any currency on earth, they go up and down, even if you compare them to other currencies, but they don't typically regain that strength. All I can say is that it's so fundamentally driven, as it always is. A break below 23.17 will signal lower prices. If gold holds above there, and it's currently at 23.43, I think it will make a stab for 2400 short term. Absolutely, it's an important fib number and a double bottom. It's a strong technical level to look at. Also, lastly, when we look at the stochastics and realize, huge caveat to using a momentum indicator, NVIDIA, if you look at it through stochastic, the thing's going to always be overbought for year and year and year. It's just saying that the price is high and it could pivot, but it doesn't have to. Gold just broke below the 20%, which is what we look for, and moved above. And when we compare it to what happened on May the 1st, that was this low here. This small dip corresponds to here, and this big dip corresponds to here. So I've smoothed this to 4, so it gives us real indication. I think that there is a more likely chance that gold moves higher. The numbers I would look at are, I think, because I don't have this up, if I can get my ribbon up, no, is about 2380 is the next major level of resistance, and the 21 exponential moving average, which is currently about $5 from pricing.
Considering the current economic uncertainties and the ongoing rise in gold prices, driven by central bank purchases and diminishing confidence in fiat currencies, how do you view the role of gold in your investment strategy? Share your thoughts in the comments section if you find this video insightful. Join our community by subscribing to our channel and activating notifications with the bell icon. Thank you for being part of our community.